Yeah, hi everyone. So, good evening to you all and welcome to the payments panel. We'll try to make it as interactive as possible since we have a very, I think, a small audience here today. We cover three aspects. So, the first aspect is about how best we could build on basically layer one infrastructures and how you could scale quite rapidly around, see the impact of AI and digital assets, how that's influencing the system. And in terms of the third aspect, it's going to be the interoperability, which is quite important both in the TradeFi and DeFi space and also amongst chains within the DeFi space. So let's start off with Sabrina here. So Sabrina, as we know, one of the most talked about topics is literally interoperability amongst TradeFi, DeFi, and then amongst chains within the DeFi space. So in terms of, we'll take in terms of Hedera, how they're going about it. Where do you see, the trends that are coming about? How is Hedera actually looking after those there?
Yeah, that's a good question because you're going from complex to maybe less complex, right? When you come from TradFi, you have to start. You have to worry about compliance. That's I think the main hurdle.
Yes.
So if you're talking about tokenized assets or stablecoins, like you have to bake more information into the asset and you have to take into account KYC. Those are like kind of the two things that typically you don't have in the DeFi platforms, or it's permissionless. Anyone can interact, through a pseudonymous account, and it's great you have that freedom. But if you want to play with financial institutions and financial tokenized assets, you kind of have to play, by the rules. So things that we found that at the technology level were important to have is so first is the digital identity, right? Slash KYC, and ideally it's on chain, so it's portable.
Yes.
So we're working with companies like Terminal 3, for example, that has the compliance, the on-chain identity and KYC, and that is at the same time still privacy preserving. In terms of the asset tokenization, so we've done some work with the ERC 3643 format, which is for security tokens, but that bakes in the ID part. So the smart contract allows to follow rules based on whether the counterpart is qualified to interact with the token or not.
Yeah.
So and then you go down to more like the fundamental, like the on-chain, the chain level, the OS, and then there are some design decisions that have been made also on our end at Hedera to allow for more controls of the assets. So, for example, our native token service, Hedera token service, allows for the issuer to have a freeze key. So the freeze key will allow to freeze an account. And then there's a wipe key, and then you can use that to wipe a balance.
Okay.
Right, and you have also the pause key, which is kind of like your red button, where you could pause all the transactions across the network for a given token. So things like that to kind of be compliant friendly. You add more programmability to the tokens so that they can interact in a compliant way. We also have like a KYC flag in the token, so you are on a white label basis as opposed to completely permissionless basis. So it's just you kind of have to make some adjustments, I guess, from the more open ethos of the decentralization. But otherwise, it doesn't really work with financial institutions.
No, that's actually quite accepted on that side. So let's bring Chen into the conversation. So I think recently USDC integrated with XDC. So how has the role now changed in terms of providing a more faster, reliable, and cross-border payment system?
Yeah. So what we had integrated over at our site was Circle CCTP V2. So that is something which allows interoperability not only via XDC itself, but other blockchains, which also include the likes of Sol as well as Base as well as the other L1s as well as L2s, which are already plugged in within the Circle's ecosystem itself. So I think what we feel is that, like there is no zero-sum equation itself. So we want to be as interoperable as possible. So I think something which you also might be good to know as well is that for XDC, we are also part of Layer 0 as well. Okay. So, like in terms of our assets and so on, they can be interoperable together with all of the L1s which are supported via Layer 0 as well.
Okay. No, that's quite interesting. So we'll bring Rahul into this conversation. So I think one of the critical aspects, because faster payments, more reliable payments is the biggest use case now for stable coins. But there seems to be a lot of regulatory hurdles that are popping by. Clarity is not yet properly known amongst various jurisdictions. So in terms of your view, what sort of assurances do you think that these regulators would want in terms of having greater confidence?
Thanks for the question. So I think obviously you stated already there's a great disparity in terms of the regulatory approach and clarity, right? So you have at one end the Western push for innovation and acceptance, and the European push for regulation and control. And Asia, I guess, you have markets like Singapore, Hong Kong, and others kind of trying to get clarity and direction. But there is essentially a spectrum, right? It's not clear what exactly is the universal landing point, right, on regulation. And when you look at the regulator's perspective, and as part of my role as an advisor to both public and private sector firms, I do spend a lot of time discussing these topics. I think the regulators are first of all reactive to what has happened more recently. So, the crypto winter is kind of getting forgotten a bit, but still the stablecoin crashes have not, right? So, and there's still about 200 odd stablecoins out there. But yet, in terms of stability, and especially as they get systemic, the question about institutional use and financial stability kind of keeps coming back to the regulators. So I guess that transparency and the backing one-to-one against the right assets is already being clearly defined in whether you look at the US or Europe in terms of regulation, right? So they have started that clearly, and that's one of the factors which I think they'll be looking for, regulators. The other bit which I think we just came up was in terms of compliance, right? So I think compliance is an area which continues to be a leading cause of concern. So in terms of how to capture and how to retain, the right level of security and trust is again something. So compliance by design is one factor, I think, which will be looked at more stringently, and it's being considered. And the other factor is just having, fundamental financial services rules, like, for example, the FATF Principle 16, and the travel rule, right? Having full traceability of where funds are coming from, where they're going. And that's just not the platforms, it's actually an ecosystem move, right? So that's, again, something where regulators are keen. And maybe the third part, I would say, is on, resiliency, and just ensuring that, you have the fundamental business continuity in case of, extreme situations. And that's, again, probably a third factor that they would be looking for. But it's still an evolving space, yeah.
Okay, that's interesting. So, Rahul, just to continue on that, so you come with a lot of experience from the times of, I would say, creating the Swift instant payments, then Project Nexus, and so on. So, to now evolving networks such as XDC. So where do you see all of this actually now fit in? What sort of challenges you see moving forward in the next 2 to 3 years?
Well, I think there's great money to be made, right, out of cross-border payments. The cherry on the top is usually FX. And if you see the problem that everybody's trying to solve is to give an instant and frictionless movement of money experience to the end users, right? Yeah. Now, I see, let me take an example of maybe 3 types of models in the, a couple of them in the account space, and then let's say stablecoins, right? So you have interoperability. Now, the correspondent banking world is spending a lot of time in removing friction from the way ultimately money moves between correspondent banks to, from one market to another via correspondent banking. And, just yesterday, some of the stats came out at Cybos from Swift that 75% of cross-border payments over Swift now take 10 minutes to get to the beneficiary bank.
Exactly.
That's an important point. And then they have also launched a blockchain layer infrastructure on top of what they have already, right? Now, I launched cross-border instant payments at Swift, right, with a 3-year kind of a program I ran. And this was before Singapore, Thailand went live and all that. And the learning was that technology is never the problem, right? It's not the technology, it's actually the business ends of it, the compliance, the regulations. All that is where the problem lies. And it's classically the last mile. Now, over time, this account, in cross-border instant work evolved from this interoperability work, which is going on, to interlinking. So you have the governments now pushing for the bilateral connections, the multilateral, the Nexus program, for example. And I was quite closely involved with that. But all of them ultimately have similar problems of, when it comes to reach, right? As soon as you get out of that central platform, you receive a payment, but to actually get it to the endpoint, you need a 24/7 instant payment system. You need to have the market practice to ensure that the cross-border payment is understood, processed, screened as required, and then move forward. Ultimately, the challenges of who's on that network as well. So you don't want it to be a club. You want it to be actually more open and accessible. Now, when it comes to stable coins and what's happened in the last, I would say 6 to 8 years, the ability to have a closed loop network, right, obviously provides benefits like atomicity, right? And the structure allows you to build more services with programmability, smart contracts, etc. And really offer, if you look at the layer ones, you offer a platform essentially instead of just an ecosystem. It's actually a platform to build new services. But to me, again, the technology works at scale today, right? It's proven. But the problem is the last mile still. And I think that that's a consistent problem that everybody's still trying to solve. How do you move the money on-chain and off-chain without, damaging the efficiency you've gained in the middle? So, people, last year I was at Token 2049 running a panel and everybody's talking about 0.5% fees and, like a couple of seconds to settle. Awesome. Now, when you don't reach the bank account on your network, how do you reach the bank account? How much money does that cost? And how much time does it cost? So I think there's this element of, technology evolving, the business model is evolving. At the same time, the last mile problem is something we all have to address together.
Okay. Yeah. You brought a very interesting point because of the last mile problem. But if you're investing those sort of funds back into a money market fund or a token money market fund, they become the issue for finding out the credibility of the source of the particular token and so on. So that's what I think Tiger Fund is facing right now to convince MAS on, they could get the right funds, the right KYC funds and so on. So moving on to Chen here now, you've seen the importance of DeFi platforms. You've seen them growing. So in terms of your understanding of probable models, where do you see, which sort of models actually do you see helping to scale these sort of cross-border payment platforms globally?
So what I see is something which is actually universally accepted in terms of compliance itself, because I feel that KYC, KYB, and so on, I think at the end of the day, very important, like what he has mentioned, like in terms of the travel rule, being able to be able to track your transactions, as well as being able to freeze your transactions if need be, like if they should be flagged out under AML or anti-terrorism financing. I think this is something very important, and this is where the role of AI has and plays, like in order to flag out such potential transactions based on a set guide of perimeters per se. So I can also point to an anecdote, like during COVID, like when all us were being bored and started to get our hands dirty in crypto and so on. So I actually went to a bank here, though I shall not name the name of the bank, and I wanted to top up my centralized exchange account. Then I actually received a call from the bank to ask me to attest that I'm not using the funds to send it for any terrorism financing. Then I'm like, even if I am, who the shit would ever admit and say, yes, I am indeed funding, XYZ or organization per se. It's like the most dickhead question to actually ask. So I think this is where I think the likes of AI as well as platforms. I think you have some in the space such as like Ga³in, for example, which actually deploys both AI as well as machine learning as well to actually help flag out transactions like this. Because I think there's an elephant in the room. It is also not a secret that compliance, risk, and so on, they are actually quite expensive as well, because all of these professionals are a cost, as well as when you actually get all the different licenses as well, they are also a cost, together with the deposits which you may or may not have to lodge with the central bank and so on. So I think this is something where AI actually has a role to play, because like with regulations and so on, you actually give businesses, I mean, though it's a necessary evil per se, but yet it does add on to the cost of a lot of startups, and especially if you are small per se, if there is a regulator which enforces that you need all this sort of license per se, you might actually face a going concern. So that is also a very real concern, especially for startups in the space, especially those who want to tackle the on-off ramping sort of concerns and so on. Yeah.
Yeah, no, that's an important point. So now we are going into what you led was the most important buzzword, AI. What's the role of AI in terms of mitigating the risk, or in other words, bringing more confidence? One is to the investors, but most important to the regulators. And AI can serve as that bridge to do that. So Sabrina, in terms of your view, where do you see the fusion of AI coming in terms of giving more confidence to both investors, regulators, in terms of risk mitigation?
Yeah, I think there were some good points earlier, right? In terms of automated screening, for example, automating your travel rule, and being able to do all these things on the fly, being able to set agents within parameters that are that could maybe adapted by the regulators. It's a very broad spectrum, right? Because AI is it's a horizontal technology. It's a bit like blockchain in a way, right? So you can really adapt it to a number of things. So just generally speaking, it's automation. But I have to say, bringing AI may also bring some risks, right? You have to be sure that the models behave the way they are intended to. If you are having, say, agents trade or transact on your behalf, you want to make sure that they are going to be behaving within the right parameters. So with that, I think it's going to be a whole new type of category of risk addressed by AI, but also risk created by AI, which I think is going to be interesting to see how that unfolds.
Yes, that's quite interesting. So recently at the Stripe tour, so they were more or less going on about the infusion of stable coins and how best they're using agentic commerce, where agents literally do from end to end, even doing your payments and so on. So that's quite interesting. So I'll just open up the floor for any questions that you may have. Yes, the gentleman there.
Right. So I'm Saurabh, and Smriti, we are building we're building the solution where like we said, the last mile, right? They don't have access to formal banking or digital devices. So we have built the offline mechanism where actually using smart cards, which we use for payments, does there for data as well and for payments as well, right? So we've kept it separate. It looks something like this.
Something like this, custom made for me.
Right. So with this, you can exchange data. So that solves the problem of last mile. And thankfully, we are one of the finalists for G20 this year. We are going to present in South Africa in November. So using that. So my question now is, when we talk about payments and coming to the example Jenny shared, right? We actually received a little bit of stipend from them, $5,000. He's been with my bank for the last 15 days. And they're like, well, you're receiving money. We cannot credit to you because RBI and XYZ. It's legitimate money and they're giving the same reason. My question is, if we enable a user profile or KYC data as a W3C verified credential, going with the payment, which could be part of the messaging, does that really solve the problem of identifying where the payment came from and who does it go to and what purpose code it should be? Would that make it go faster? And the related question to that is, in addition to Visa or MasterCard as the payment layer or the transaction layer worldwide, could it be XDC as the infrastructure layer, or could it be Hedera, which could enable cross-border transactions, right? And with the verified credential, which could be typically in a NFT JSON file, who is the user and who does it go to? Does that really solve? Because otherwise, we talk about financial inclusion. With growing digitization, 750 million people worldwide, they don't have mobile phones, so this we cannot do nothing.
Sure, I'll kick off. So, by the thanks for trying to address a very important point, right? And this is real friction that you're trying to address. The biggest problem I see is trust. Yeah. So, where is data coming from? Where is money coming from? And where is the data going and where is the money going is classically the question. When it comes to regulated institutions, right, the other problem is liability. Okay, so it's a mix of these two factors, trust and liability is the way I look at it. So trust means you have some verifiable credentials, right, that's coming through it. But what is your veracity as a platform? And how trustworthy are you? So that'll be the first question. Yeah. If I am, let's say, a financial institution, let's say, right, or I'm a layer 1, or I'm one of the fintechs, okay, whoever might be processing that information across. What is my responsibility in taking that data and screening it or validating it to the best possible extent? So when I was running cross-border instant payments, right? So one of the regulators asked that we were designing in the clearinghouse with 20 banks and the regulator there. We were designing the local infrastructure, okay? And they came a question market practice. He said, screening is a big problem because now all these instant guys, their banks have to do instant screening in real time. It's a big investment, right? So how about we do $2,000 and below, no screening? Yeah. This was a suggestion, okay? And he said, I was representing Swift at the time, and he said, so what do you think? Is that a good idea? I said, it's a great idea, logically. But the problem is that whether it's $2 or $2 million, if it goes to terrorism financing at here or this end or that end, everybody gets pulled up. The central bank will pull you up. Right? And then the question of some of the financial institutions spoke with me, especially the multinational banks, they said, our compliance team will not let us do that. We have to screen every single transaction because it's our liability. You will hold me accountable. So you see, liability and trust, right? And these are factors you'll have to consider, and that then is a public-private dialogue. Yeah. So it goes close to the regulation.
I want to say if you do the $2,000 rule, then you're going to have people break their transactions in $1,999. Right?
Fraudsters follow the thresholds. Yeah.
Interesting. So, any further questions? Yes, the gentleman here.
So, stable coins, there was a recent cited report that says that, what ChatGPT did for AI will be the similar thing that by stablecoin with respect to blockchain. Talking from the enterprise standpoint, what do you believe would be the first adoption? Will it be a stablecoin or maybe other blockchain-specific use cases?
I like the analogy because I think, blockchain, one of the key values of the blockchain is putting value on chain and putting information on chain, right? Like those are the two things that you want. Those are two use cases and you can build on top of that. So I do find that stablecoins are they're going to accelerate a lot of things. Of course, they're transforming payments. They are transforming capital markets just on a broader basis. And that comes hand in hand with tokenized assets. So you have tokenized assets that they're on chain, and then the payment is also on chain. So instead of having two different, one rail for the asset and one rail for the cash, you have everything on the same rail, and then you can start doing, delivery versus payment. You have you could start doing instant transactions. I mean, I guess to the extent that they are qualified and screened and everything. So you can start moving value very, very effectively on chain. So maybe I'm digressing a little bit, but I think stablecoins are very, very essential to. It's not what stablecoin doing for blockchain, more like what stablecoin doing for capital markets, really, in the grand scheme of things. Yeah.
Yes, the gentleman.
So, what are the top three asset classes that you would think of, let's say, next 20 years, especially tokenizing assets?
So, I mean, I guess if you look at stablecoins, that's FX markets, right? Currency markets. That's already a major. If you look at just the market caps of stablecoins, that's already major. If you look at the volume of stablecoin payments, that's already kind of surpassing like Visa, for example.
And MasterCard.
And MasterCard together. Second is kind of your boring fixed income, your treasuries and your money market funds. They've found a product market fit already within the crypto ecosystem, because they can be used to back stablecoins as collateral. They can be used for margin trading and things like that. So that's a very clear use case also. And then you have, I would say, assets that require a lot of programmability, like, say, green bonds, for example, that are kind of complex. You have rules, you have, conditional payments and things like that. You have data coming in from the project. That's a very good fit for smart contracts and the programmability that comes with it. Of course, it's not limited to that. I think pretty much every major asset class is going to be on chain, but maybe I'm a bit of a maximalist. But those are like some interesting ones to begin with, and I don't know if you guys have also favorites to share.
Just add on, tokenized deposits. I think there's a rising fear of a run towards, yield-bearing stable coins. And there's some interesting stats coming around that, right? There's a feeling that actually 40% of deposits could flow out of traditional banking. I think that's an extreme case, but that's another interesting dynamic, right? I think some of the question about stable coins, I kind of look back at the history, right? And if I do a quick timeline, so you had Bitcoin 2008. Then you had, Libra as the probably outlier. Okay, that came up in 2014, something like that. At the same time, there was conversation about stable coins propping up. Now, Libra had a massive knee-jerk stop reaction from the regulators, right? Stable coins did not. So that's one clear indicator to you, right? That there was something different about what was being proposed. And there is indeed, right? It's almost sat in that beautiful zone between the unregulated and the regulated, and the dynamic change thanks to some of the work with the circles of the world and others to kind of get that closer to regulation, and hence getting acceptance and adoption, right? So I think stablecoin is winning the race because of that closeness and the fact that the regulators, and thanks to Mr. Trump, getting that push across. Some historical relevance is also important there. Why and which one would kind of take on that?
Yes.
Related to stable coins versus CBDCs, do we think the CBDCs are kind of the CD moment of the industry? I mean, it came and got passed over.
That's actually a good question, actually.
Okay, happy to take it. So this is that kind of question where I say, let's go back to what's the problem we're trying to solve, right? And I think, unfortunately, CBDCs is a public-driven, alternative to cash. And the challenge is that you already have alternatives to that, that we use, like, for example, a market like Singapore. If tomorrow you're given an option to have another wallet from the government and put e-Singapore dollars on it to use for whatever purposes, it would be impossible. Now, you moved, and that's because there's infrastructure already, right, at play. And many of the markets have leapfrogged in the last 10 years to kind of provide at a retail level multiple options, right? So there's already a good payment ecosystem, right? Supporting instant payments and all the other benefits and growing. At the other end, you have kind of the cross-border space as well. So there's a lot of talk about CBDCs in the wholesale space. It's yet unproven. So there's a lot of work and effort going on. There is kind of the, you can say the ECNY to Hong Kong kind of corridors. I mean, I'm not surprised. But yeah, in general, it's still at an early stage of being not really proven that it's actually really adding a lot of value. So there is value in, like I spoke to the Central Bank of Bahamas. I asked them, why did you launch a CBDC and why didn't you go to an instant payment system? Fundamental question, right? And the answer was it was a bit of an eye-opening for me, because he said, actually we have a lot of islands and there are boats that need to carry cash. So we were looking for a replacement because we didn't want the risk, of the boats sinking or, getting, so very different problem from what we are talking about. Okay, we're not talking about financial inclusion here. We're not talking about digital. So the problem was that. It was aha, really. I was going to go ballistic on him later, but then when he said that, I was like, okay, you have a case. Then you convert the cash to digital cash, and then there's help, right there. So there are cases, very few, and there are 10 markets today, I believe they are live or near live in CBDCs, but that's really way less. Yeah.
I think it's a bit unfair to compare CBDCs with stablecoins because they're on a different adoption curve, right? Stablecoins, it's obviously it's a private sector, so things are happening faster. CBDCs is public driven, and so of course it's a longer adoption cycle. This year is definitely, I think it's a year where where stablecoin adoption has really taken off, and where regulation has, in a number of countries, starting with the US, has kind of eased up. So I think, the trend is there, but that doesn't necessarily mean that CBDCs are dead. I think there are clear use cases that, if governments want to push it, they will be able to. I mean, you take Singapore. If you wanted to just like have your CPF, your CDC vouchers, and whatever other kind of welfare disbursements, if they were to happen in CBDC and that was interchangeable with SGD or another stablecoin, of course people would adopt it, right? So I think it's a matter of like what's the benefit for retail? I don't know that it's necessarily for wholesale. Yes, it may have some benefits, but it might compete directly with stablecoins, and what may the best system win at the end of the day. But I think for retail, it's like financial inclusion at birth. You're born, you have a wallet, and then you can already get your medical benefits or whatever, your scholarships or anything. All that stuff can just be tied to your identity, just as you're born with an identity or born with an ID number. Why aren't you born with a wallet? Right? Like that's, I think, is a basic infrastructure that every citizen should have. But yeah, so different use cases, I think.
Yeah, I just want to react to the, when you think about mandating, right? Like, for example, the government gives you a wallet and says all your government subsidies, taxes, whatever else comes to that wallet, right? And you have an ecosystem where you have, let's say, strong wallets in place, private wallets. What happens is the subsidy comes there. The next second it goes to that wallet. And it's over there. So it's just passed through. Does that gain adoption, or does that just gain, mandated use? So mandated use, in my, kind of view, it just goes that much. You have to have that private sector use, the scalability, the use cases, the overlays, institutional adoption. Otherwise, it'll just stagnate after some time. So it's very important for that to work. And though governments are indeed trying and offering that alternative, in some cases this is what happens. It just becomes a pass-through rather than an actual alternative.
Awesome. Any more questions? Okay. Yeah, I think. Sorry, you have.
I was gonna say you could also make that money programmable and like keep it within that account. So like you can make sure that that CDC voucher is only used for vegetables and like your prescriptions as opposed to, I don't know, like cigarettes and booze or something. But anyway, I think
It's a mandate, right?
Yeah.
So anyway,
To add to that, actually, we are working on a use case where for schools, now that, if you have a school canteen and, kids and children go and they want to buy some food or something, we actually said that on our card, we are enabling that if the parents load up, let's say, 100 rupees or 200 rupees or something, it can only be used in a
Certain
school
purposes.
canteen
Sure.
and not anywhere else. And they, of course, have visibility. So,
I think that's a great card use case, right? And that's right. That's about spending and consumer behavior. But we're talking about actually where the funds are being accessed from, right? So I think they're two different things, right? And no doubt about that being useful. But where the money is and how you're using it becomes the question.
Yeah, two different things.
Yeah. So because if you take Aspire, I think they made a lot of money doing expense management for the employees on the same principle that you simply mentioned. So I think since there's no more questions, we'll just wrap it up with one key question from each of the panelists. So in terms of 2026, what's the key trend or what do you need to look out for in the DeFi space? I will start off with Chen.
Yeah, so I think what I see would be potentially more digital assets being able to be used for loans. Like rather than usually like currently most of the players in the industry, they only accept BTC and some would do ETH, but I feel that like with like the proper analysis of the volatility of each tokens per se, you can then also try to see what is the percentage of loans which you'll be able to grant, bearing in mind the market depth as well as the volatility itself. So I feel that that is something which we can potentially see in the DeFi space for next year.
How about you, Rahul?
So you asked about 2026. It's almost there, actually. But I was hoping for a 10-year question, but never mind.
You can edit
No, it's okay. We have Elon Musk to help out. Hold on. So Elon said that next year we'll achieve AGI, right? So human-level AI capability. And 2030, AI will surpass all of humanity's intelligence. So my hope is actually, man, my kind of maybe I'll go a bit beyond 26 here. My hope is actually that the form factor and the form factor of money and the discussion about infrastructure, right? It should cease. It should cease to the point where trust, compliance, regulation is standardized, homogenized, automated to the largest possible extent, and it becomes invisible. Because the focus should shift from infrastructure to the consumer. And that's where AI will play a role. And it can only do its business if that trust exists. If the infrastructure is so seamless and frictionless that, you focus on what the consumer wants. So in my mind, if I look at just a simple, good retail case, right? I would love my kid, for example, to, tell their friendly AI butler, financial services butler, to plan their trip to, let's say, Bali with their friends. And the agentic AIs will, huddle together and figure out the tickets and the bookings and everything and the money. And it'll all happen, right? You don't need to sit on it, do anything. And don't care where the money is going from either, because that's got to be managed. And you can be told. And if there's an executive decision, you'll be asked. So, to me, I hope that AI, kind of raises the bar. At the same time, we lose some of this friction, and infrastructure just converges and adds value to it. Thank you.
How about you, Supriya?
So in the DeFi space specifically, I think, we're originally, I think DeFi as a permissionless, environment has allowed for a lot of innovation, which is super interesting, right? I think of DeFi as this is the lab, and institutions are really kind of picking up on that and taking some of the primitives, and they have to adapt them to their regulatory and circumstances. But what I would like to see more of is like, liquidity pools like managed by institutions in a compliant way and things like that. And also DeFi protocols are now being established to function in a compliant way. Like a DGFT, for example, one of them where, everyone's KYC'd and you're able to buy either digital native issuances or wrapped issuances, and I guess if you're going to be onboarding like a lot of the capital markets, it's gonna be that form factor, which is a little bit of a compromise. Yeah.
Super. So thank you very much, everyone, for joining this panel, and a big thank you to our panelists, Sabrina, Rahul, and Chen. Oh yes, we'll take a photo as well.
Sorry.